Awesome. So glad to have you back, as I really think the subjects of how to identify financial moats is critical to becoming a successful investor. We're going to jump into some individual components found in a moat, and this knowledge will help you identify opportunities to make money and might even help you identify potentially bad investments, which should be avoided. Now here's the categories, and I'm going to discuss each one with a business example. Ready? Patents, brand loyalty, scale and logistics, regulations, first mover, new industry, duplicatable, natural resources, and a stable government. If you're strapped in, let's dive into the details, starting with patents. The average person thinks a patent protects you as a business owner, and that is far from the truth in real life. In the real world, it can easily cost you 6 or 7 figures just to defend a patent that's already been granted to you. I know. I have several patents, and I've reviewed every filing and paid for every application fee, lawyer, and maintenance fee. Once granted a patent, you must defend your patent if someone challenges it. That's right. Just because you jumped through every hoop and paid every fee to be granted a patent does not mean anything if another company wants to copy you. I've personally watched a company exactly copy another company's product, and when challenged, simply replied, "So sue me." The thief's attitude, "Thanks for proving there's a market out there for this product or service and doing all the research and hard work, and now I'm going to steal, challenge your patent." It costs multiple times more money to defend a patent than it does to be granted a patent. The process takes years, and even if you win, good luck trying to collect money from the thief, as they have many tricks up their sleeve to never pay. Here's your pro tip for businesses who use patents as their moats. If the company is a drug manufacturer, your moat is probably good for around 10 to 12 years. Why? Don't patents protect you for 17 years? Well, it's because you lose years while you're developing the product. It's difficult to launch the product the same day you get your patents granted. The minute you file a patent, competitors can see what you're up to, so secrecy is a big part of the process of when to file. Drug companies that go off patent are subject to generic competition, but one big caveat is the drug companies that make these highly complex formulas like Amgen. They're called biosimilars. They're much harder to be granted opposed to the lower hurdles of most simple compound generic competitors. But sometimes drug companies, they tweak their original formula for improvements, then apply for new patents so they can extend their protections. Sometimes it works. I also like companies with patents in technology, but they really need a portfolio of patents in one area of tech to prove a defensible moat. So tech patents can be good if competitors infringe on their inventions and become successful. I'll give you an example. A success that has widespread adoption of the infringement can lead to huge settlements in court cases. Carnegie Mellon won a $1.17 billion verdict against Marvel Technologies in 2013. In general, you never want a business salvation to be court, judges, lawyers, and expensive uncertainty. But best to have a business strong in the court of public opinion and loyalty. That's the better moat. Pro tip: patents are excellent to have and should be utilized when appropriate, but rarely provide the moat protection many investors believe they possess. What does customer loyalty look like and how to identify? Easy. Just look around where you live or work and items or services you use or consume each day. Remember the deserted island question, what can't you live without? Well, as you think about this, you're quickly going to identify in your personal life brand and customer loyalty. And what does brand loyalty look like in a moat? Well, I mentioned Disney in the intro. They have many moats with certain nuances. So here in Southern California where I live, the first Disneyland was created, and several years later, not too far away from Disneyland, is Knott's Berry Farm. A few hours from each is Six Flags Magic Mountain, Legoland, and SeaWorld. The Disney moat was not the amusement park concept or the rides, but the combination of the characters of Disney and how they interacted with the guests, along with an incredible discipline to provide a positive guest experience. The CEO of Disney, Roger Iger, he commented during the Pixar takeover that it was an easy decision for him and his executive team because most of the park visitors are already identified with the newest and best attractions with the Pixar characters. Apple has become synonymous with brand loyalty. This has become the basis and foundation for their moat. Now, they have scale and so much more than simple brand loyalty, But people forget Apple was once on the verge of bankruptcy. They had to be rescued by Microsoft. This is another video for another day, so hit the notify button and we'll let you know when this video is ready. Apple had a 3% market share versus Microsoft with 96% and 1% for the others. Those 3% though were fiercely loyal, and mostly they're comprised of these artistic crowd that did not want any hassles from their tech and appreciated the simplicity and ease of using an Apple computer. They were willing to pay a premium for this experience, and they remained loyal. Many people believe the catapult for Apple into the stratosphere of business that helped make them the most valuable company on earth was the iPhone. Well, that's not entirely true. To be more specific, it was the ecosystem of the iPhone combined with their desktop products. At the time, there was also Ericsson, Motorola, and Nokia. So how did these multinational billion-dollar companies have their moat destroyed by a startup that was in the computer space? In the Apple ecosystem, you can interact with FaceTime or messaging or whatever better way of doing something Apple's figured out. People not only paid a premium for the phone, but waited online to purchase a new model. Nobody ever waited online to buy phones from their competitors. But beware brand loyalties based on fads and short-term trends. Typically, they're not sustainable for the long-term needed to make for a profitable long-term investment. I'm a weird dude. How can you tell? Because I get excited about talking about logistics. Yes, the act of getting items or services to where they're needed by the end user is terribly exciting to me. And I talked about this subject in one of my videos for valuations. I personally think every single business outcome is decided by logistics. Same for winners and losers in war. Do you really think Amazon is successful because of their migration from a bookseller? Or is it because they are dominant in getting items people want in a fast, affordable method with multiple choices? Amazon, and the genius of Jeff Bezos, is a full course class in business. Walmart had dominated with their huge stores, warehouses, delivery, trailers, and purchasing power. Amazon used the infrastructure of UPS, FedEx, and the United States Post Service to help them logistically deliver their items. In the ultimate evolution of this cycle is Amazon's dedication to client experience with the speed of delivery and low cost has led them to create their own truck delivery, airline, and regional warehouses. Even Amazon's backend for computer services turned into a logistical machine, and now Amazon Web Services contributes a huge portion to Amazon's profitability. Often, they make money moving on the logistics of Amazon Web Services or AWS than they do selling all the widgets found in the smiling cardboard boxes. And consumers will almost always choose the lowest cost price of anything when items are identical. Amazon had a huge benefit over all the retail competitors, and that benefit was taxes. Amazon took advantage of a moat courtesy of the US government and their ignorance of the digital transformation. For years and years, Amazon and online competitors were able to sell their products tax-free because of laws allowing companies the shelter if they had no physical stores in the states in which they operated. Well, technically not tax-free. That's incorrect. See, a law going back decades when buying from a paper catalog and 1-800 number, this law said if you didn't own a retail store, then you didn't have to collect sales tax in the state where the item was delivered. So, a loophole about 1,000 miles wide gave Amazon a political moat. Every retailer complained, saying they were simply showcasing an Amazon sale when consumers visited their retail locations and used their salesperson's time asking questions. Let me see, delivered to my house and I save 5, 6, 8, 10% tax? Easy decisions. And next thing you know, Amazon is selling big screen TVs, computers, refrigerators. Bottom line is if you're a consumer and are thinking about buying a TV, a computer, appliance, or anything of high value, you can instantly save the sales tax from the state by buying from Amazon and not your local retailer. The law stated individuals must voluntarily account for all online purchases and pay taxes, but you know, things got dropped at the docks. States collected less taxes from consumers, less tax business income, less retail property tax as businesses closed because retail shop sales decreased, while labor and other input costs increased. For another example of political moats and how an industry can be quickly affected by regulation and change, I'm going to turn over to my partner Adam Myers back in the studio. Adam.
Thanks, Ian. One of my moat destruction stories to share is an unfortunate tale attributed to New York taxicab drivers and their medallion stamps. I think what has happened to that industry is completely unfair. For decades, New York has maintained laws that you can't operate a taxi without a medallion stamp. These stamps sold for up to $1 million each. Then came Uber and Lyft, and instead of the government protecting this moat, they did nothing. For years, the government regulated the growth of this industry by restricting supply and demand and imposing rules that were rigorously enforced. Before Uber and Lyft, you had gypsy cabbies in New York. That wasn't safe and is not what you wanted. Uber and Lyft were needed and are convenient. The problem is another industry got destroyed because the government did not protect their moat. This is a perfect example of moat destruction via government ineptness. In the blink of an eye, the damage is done, and now that can't be undone. Consumers can't be told they can't use Uber or Lyft. The way I see it is the New York government allowed competition to come in and crush the moat that was well established and protected by laws. The byproduct is better service for the consumer and ease of getting transportation. But the streets are packed, traffic is delayed, and taxicab drivers are committing suicide because they can't make their payments on their medallion stamps, on those loans, or even feed their family. Here's a pro tip. Never rely on government regulation as your moat barrier. They are highly unreliable, illogical, and often implement rules and laws created by people with no business sense. In my humble opinion, a tax can be created from Lyft and Uber and figure out a compensation formula for medallion stamp owners. Offer a one-time cash out offer that is fair to medallion stamp owners and open the ride-hailing market to everybody that abides by the municipality's local laws and regulations. I think that would be a great first step to correct this dilemma. Ian, I'll send it back to you to dive into the advantages of being the first mover in an industry.
Thanks, Adam, for sharing that story about the medallion owners. I hope that gets changed. It doesn't seem fair to me either. But fair and business sometimes don't go hand in hand. First mover advantage in moats is very tricky. The instinct is to reward the inventor of a new product or service. Innovation always wins, right? Wrong. Apple didn't invent anything, but they did innovate and made each thing they touched better. Same for Japan when building cars with great gas mileage 3 times the range of our cars in the US. Or Facebook with social media, or Google for search. It's incredibly hard to invent than it is to innovate to maintain market dominance. Instagram and Snapchat are not the innovators, nor is Spotify, but they dominate their fields because of seeing the potential of a market created by others. They are not stealing, but innovating in their own way, in the natural evolution of business using capitalism. Napster could have been Spotify, but they didn't monetize properly with the agreements with the labels. Hulu was created because the founder, Jason Kilar, was smart enough to realize the path to success was partnerships with all the media owners, so he made them equity partners by selling a stake in Hulu. Being first is not a moat. Being best is a moat. New industries are created in various ways, and you should look for moat opportunities. An example is GPS, which was invented by the military and the tech crossed into the consumer market, with Garmin being probably the earliest leader. And Garmin quickly focused on this new market with an emphasis on quality and innovation. Well, if you're going to put a GPS system in a plane, semi-truck, fleet, or hiking tracker, then you're willing to pay a small premium for an industry dominator focused on quality. The internet was a new industry that created multiple sub-industries. So that's a broad example of industry birth. But if you were to analyze some of the tech companies, tech industry dominance, then you could say IBM had a moat, and so did Cisco. If you were an IT professional in the 1990s, let's say a CTO with a big budget, and you tried to save money by purchasing equipment from competing providers, and then your company experienced some type of equipment failure, then your job, no, maybe your entire career could be in jeopardy. But if the failure was from products based on, let's say, IBM or Cisco, your defense could always be, I went with the biggest and the best. So your job security was a moat for these tech leaders. Happens all the time in business, and it's called protect your ass purchasing decisions. New industries are being born today includes artificial intelligence, CRISPR gene design, remote robotics, material science, energy conservation, food production, and so much more. This is why the future is bright, not blight. what is good for you has to be good for me. Why don't I just copy what you're doing? That's not fair. Stop your crying. No one cares. Wrong, right, fair. In the real world, if a product or service is easily copyable, then it will be copied quickly. And if it's complicated, then it will take a few more hours for somebody to steal or copy your idea. We live in the maker generation where someone can use a machine and a CAD drawing to print out a car part and use the same machine to make a gun. Almost anything could be copied easily. You know what can't? Scale is hard to duplicate. For example, U-Haul, company's called Americo, but you know it as U-Haul. Penske and many others tried to compete and copy their model, and everyone found out how quickly it is to get locations all over the USA. That makes cost and service competitive. If a company is some type of .com, then the barriers must be unique because someone will copy it. There's a German-based company called Rocket Internet. Simply copycatted works somewhere else with nearly identical but legally different versions of whatever they're copying. Here's some examples. Domination of natural resources is a unique moat. Earlier, I mentioned the majority of the world's rare earth minerals are controlled by China, and other examples would be lithium. Production is mostly Chile and Australia. I also mentioned earlier Japan makes efficient cars, but they have little to no natural resources to make those cars, as they rely almost 100% on importing all the raw materials. Another unique moat example is some foods. Truffle mushrooms don't taste the same if they're grown anywhere other than France. Same for Chesapeake crabs, beluga caviar, Iranian saffron, Canadian or Vermont maple syrup. I will have other videos that talk about the global importance of natural resources, but this video is about you becoming the best investor possible. And my pro tip is to be careful investing in themes based on natural resources. If you find a theme you like and believe in, then my advice is to learn all you can and try to bet big, as long as you can afford the losses if your idea doesn't prove successful. I'll give you an example. The petroleum economy gave you incredible returns for almost 7 years until just recently. Now, I consider this an example of a natural resource for moat theme investing. Today, it might be lithium, rare earth minerals, or some type of other natural resource for investing. The theme, clean water, clean energy. If you like this theme, you might buy some ETFs based on water energy. And I'm not paid by some of these sponsors, these are just examples. Do your own research before buying or selling anything. Watch my other videos and learn. Or maybe look at the top holdings of each ETF and pick the ones you identify with for some type of theme story. My video on stock investing will help you filter what to look for as far as PE ratios and other financials of an individual company. The final mode I want to discuss is a stable government. And why did I choose this topic for last? Well, because the business you have doesn't matter if one morning men wearing suits with shiny medals and guns take over your company and country. They do not have to take over the country to be inept or corrupt, typical stuff. When you want to own the biggest, most profitable oil company in Brazil, some do, or did, and might once again. My point, the dominance of one company in an oil-rich nation is a slam dunk decision for making money, but that falls apart very quickly if all their problems translates into real-world economic losses. They can't sustain the economic machine when oil is worth a low per barrel price. I'm not picking on Brazil, as they are beautiful people with rich culture, and other countries are having the same problems with economic and political stability, including Mexico, Russia, Canada, all because of petroleum. Another example of a government moat is licensing rights and auctions for wireless spectrum for cell phones and data services. India sued Vodafone for a $2 billion tax claim based on some dispute. And details don't matter for this example of government moats. The lesson is the government has the power, and relying on the saving grace of justice and fairness is not something a person with a weak stomach should invest in. Now, ultimately, Vodafone won because India joined the International Arbitration Tribunal and accepted their ruling. However, there's still potential for India to protest, so entire business's profitability can be potentially wiped out from a government action. What would happen to your company moat if the government changed the way they did something? Apple hasn't been paying corporate taxes in a similar manner to other USA companies pay. And that's because they offshore in Ireland and then subsidize in the Bahamas. The European Union in September 2020 said Apple should pay back taxes for about $15 billion. Look, this is really a large sum of money, but it's not going to break Apple's bank account or cause them to change their ways. So, be wary of businesses where large parts of their moat are defined by government in which they are based or the governments in which they do business. A sudden tax or tariff could wipe out a business in weeks. Watch the Godfather movie when Michael Corleone quickly discovers Cuba isn't theirs anymore because their guy, they just left the party.